Hello and welcome to the Business Standard Morning Show. I'm Veenu Sandhu. Let's take a look at the stories for the day.
रामू दो चाय दे यार।
अरे नहीं यार, एक चाय कॉफी।
We Indians disagree on everything, but we agree. SBI is the banker to every Indian.
SBI का home loan? I agree with you.
SBI is the banker to every Indian.
Roiled by domestic shortage of edible oils and protests over it in the run-up to Eid, Indonesia has put a halt on export of palm oil, the mainstay of its economy. Its ripples will soon be felt in India, which imports almost half of its palm oil from Indonesia. Prices of edible oils will be on boil, and combined with an increased fertilizer subsidy bill, soaring fuel prices, and coal shortage, this may widen the country's current account deficit. Let's see how.
It is not just a cooking oil confined to kitchens. Its derivatives are almost omnipresent. From cakes, biscuits, and chocolates that you relish to the beauty products. From cleaning agents to laundry detergents to margarine. No wonder shares of FMCG companies dropped up to 6% on Monday when the news flashed that Indonesia was putting a halt on export of crude and refined palm oil. Higher prices will increase margin pressure for consumer goods companies like Hindustan Unilever and ITC. The ban by the world's biggest palm oil producer and exporter came into effect on Thursday. It could further inflame surging global food inflation. India is the world's biggest importer of palm oil as well as edible oils in general. Palm oil is preferred in India's food service industry as it is relatively cheaper, lasts longer, and is more stable at high temperatures than other oils. Indonesia has said that it will revoke the export ban once the domestic prices of bulk cooking oil come down by around 30%. It consumes less than 40% of its annual palm oil production of 48 million tons, and the rest is exported. Industry officials don't expect the ban to last long due to limited infrastructure to store the surplus oil and mounting pressure from importers. India consumes around 24 million tons of edible oil annually. About 10.5 million tons of demand is met through domestic production, whereas the rest of the 13.5 million tons is imported. More than 60% of this, around 8 to 8.5 million tons, is palm oil, and 45% of that comes from Indonesia and the remaining from the neighboring Malaysia. The prices of vegetable oils like mustard oil, sunflower and palm oil have gone up by as much as 25% over the past year. Sudhakar Desai, CEO of Imami Agrotech, says Indonesia's export ban cannot sustain for more than 10 to 12 days.
Basically, this issue started because Indonesia wants to reduce the domestic price table for the common consumers. And that's why they've tried various measures. They've asked all the players to supply minimum quantity into the domestic markets. And at the same time, they also tried to artificially control the prices. But whereas that has made the exports more profitable for them. So they found that while the exports are robust, the domestic supplies got depleted. Number one, Indonesia produces nearly 40 lakh tons of oil per month, out of which they consume about 600,000 tons, 6 lakh tons domestically, and another 6-7 lakh tons for biofuel. The balance 20 to 25 lakh tons they have to export. So first of all, I think this export ban cannot sustain for more than 10 to 12 days. So this would mean that the world markets has to shift to Malaysia, and whereas Malaysian stocks are already tight. As far as India is concerned, we've been getting some oil from Thailand also. We can expedite a little bit more from Malaysia, and there are stocks in the pipeline. As far as rupee consumer impact is concerned, 6 rupees has already gone up, so probably another 4-5 rupees per liter. Prices can go up till the time this issue is resolved. Meanwhile, we have domestic crops which we can expedite. Domestic soybean crush, domestic mustard oil crush, that can increase the availability.
The current situation has also highlighted the need for self-sufficiency, or at the least to reduce import dependence. The self-sufficiency in oilseeds attained through the Yellow Revolution during the early 1990s could not be sustained beyond a short period. Several steps to boost oilseed production have been taken since then. One of them is the recently launched Oil Palm Mission with the objective of producing 2.8 million tons of palm oil locally by 2025 to 2030. However, even if the mission succeeds, it will not significantly lower import dependency. Despite all the measures, India's reliance on imported edible oil continues to grow. It is also possible to reduce the consumption of vegetable oils by creating awareness among the consumers about optimum and healthy oil consumption habits. As per nutritional requirements, 12 to 13 kg per person per annum is sufficient, while an average Indian is consuming more than 18 kg per annum. Desai says India's edible oil consumption has been falling marginally over the last 2 years and is expected to fall 2 to 3% in the current year. He added that high prices are already encouraging farmers to grow more oil seeds.
I think we already saw oil palm mission. Of course, that is a little bit medium-term issue because it will take 4 to 5 years for the oil to come out due to the gestation period of the palm trees. But when you talk about other crops like mustard or groundnut or sunflower or soybean, these are all short duration crops, 90 days to 100 days. So with the right, it is also a big opportunity today. The price table being high is making the oilseed cultivation more economically profitable. So for the right reasons, the acreage will shift. And as a nation, we also need that shift from excessively produced agriculture crops to oilseeds in which we are deficient, because nearly we are surplus in everything, wheat, rice, dairy, sugar cane. The last 2 years, let me tell you that soybean and mustard crop has gone up by nearly 25 to 28% because of the price. So it will grow faster with the right focus by the industry, by the farmer producer organization, by the government, with the right technology and hybrid seeds, right application of fertilizers. So a combination of these things will gradually move us towards better placed self-sufficiency.
India's vegetable oil import bill jumped 63% in the 2020-21 marketing year ended October 31 to a record $15.7 billion. The volume of imports remained roughly the same as the previous year at around 13.5 million tons, but the value spiked as overseas prices surged. The import bill may go up slightly this year. The crude oil import bill doubled last fiscal to $119 billion, and oil prices are staying elevated due to the war in Ukraine. The country is also staring at a coal shortage. Several states like Tamil Nadu, Gujarat, Maharashtra, Karnataka and Uttar Pradesh are stepping up coal imports by paying high prices to overcome a domestic shortage. India's fertilizer subsidy bill is also likely to shoot up by 55% to a record 2.5 trillion rupees this fiscal, as the government will provide additional funds to make up for the spike in cost from higher import prices. India imports 90% of phosphates, 30% of urea, and 100% of its potash requirements. Ukraine war has shot up the price of natural gas, which is used in making urea. Against this backdrop, the International Monetary Fund has estimated India's current account deficit to widen to 3.1% in FY23 from 1.6% in FY22. A host of factors such as rising prices of crude oil, coal, vegetable oils, fertilizers and natural gas will continue to put pressure on India's external position going forward.
सब अच्छी दिख रही हैं यार, कौन सी खरीदूं?
ये तो वही बात हुई, 4000 शेयर्स लिस्टेड है, कौन सा लूं?
वो तो सबसे आसान है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा पर है 4000 स्टॉक्स की रिसर्च, टेक्निकल टूल्स और इन्वेस्टमेंट आइडियाज। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
India Inc. is also facing the heat. The rise in prices of commodities and disruption in the supply chain is increasingly eating into its profit margin. In an interview with Business Standard's Arup Roy Chaudhary, CII President and Global CEO and MD of Tata Steel, TV Narendran explains why he believes that this may not derail growth in the long term. Let's listen in.
What is your assessment for FY23 as we go into FY23 at a time of volatile commodity prices and disruption in supply chain?
I think one learning all of us as corporates have is we need to build resilience and agility into the way we work. Because whether it was a pandemic or whether it's the war, these are global events which we have no control of, but has an impact, has a local impact. Having said that, overall the sentiment is still positive. We have a CII toned down the growth forecast a bit. We had originally felt it would be in the 8.5 to 9.5% range. We are now saying it will be around 7.5 to 8%. So while it is toned down, it is still very strong. 7.5 to 8% growth makes us the fastest growing large economy, and that's higher than the growth that we had even before the pandemic. Our members are quite positive. When we spoke to them in March at the National Council, which was after the Ukraine war had started, of course, number one concern was commodity prices and inflationary costs. But overall, pretty much 70% of them said that they were going to spend more capex than they did in the past. There is a bit of turbulence, but nothing which nothing which we expect to derail the growth trajectory very significantly.
More than growth, actually, as you mentioned, the concern this year is inflation. Now we know how inflation will impact households. It will eat into their savings and consumption. How will it impact corporates? Will corporates be able to pass on all of their input cost increase to customers?
At least some of it will be passed on, may not be all. And then you also need to then look at are the export markets which can absorb that. So many corporates are looking at that. If the domestic market can't absorb all the inflationary pressures, can export markets absorb that? That is one thing. Second thing is, obviously there will be some margin compression, but it doesn't mean that you will make losses. So I think that's the second part. To me, corporates are looking at inflation with obviously some concern on input costs. But this inflation is also helping some corporates. For instance, if you're in the commodity space, high commodity prices is actually encouraging you to invest more so that you can grow your capacity, and capacity utilization is strong. If you are a farmer making wheat, today that inflation is actually helping you, in some sense of the growing wheat, that it's helping you. So there would be some sectors who benefit from higher prices, some sections of society which will get impacted a bit more. But we feel that with the government's focus on infrastructure spend, the supply chain issues will keep getting sorted out a bit. The demand side growth will be strong. And with more incomes going to rural economy because of higher food prices, consumption which was fragile may recover. And also with many other high contact intensive sectors like hospitality, travel, etc. coming back, restaurants, we see that household incomes will also get stabilized.
As you said, if not all, some corporates could see their margins being hit because they will not be able to pass on all of their higher input cost to customers. So on one hand, you have some sort of hit on margins because of inflation. On the other hand, while capex has picked up, again will we see it will not pick up as much as the policymakers are expecting or yourself were expecting. Another year where private sector capex is still not getting to pre-pandemic levels. Will we see that this year, or are you?
I think we feel that the sectors who have announced a capex will continue to spend, if not accelerate. Like I said, metals and mining. Whatever capex they announced 6 months back, they probably want to do more today. That is one. Other sectors which have announced capex are chemicals, and the exports has been strong. India's exports has been very strong. Third is electronics manufacturing, which is more linked to PLI and the potential of the domestic market. Fourth is supply chains, warehousing, etc., which is also very strong because of e-commerce and things like that. And then there are newer areas like the climate economy, people investing in recycling, people investing in hydrogen, people investing in electrolyzers, whatever. So,
there's an expectation that, PLI scheme will create jobs over multiple years. Although compared to 2020, the employment numbers have improved. And for this, since the government data itself is not that trustworthy, we are looking at CMI data. However, there's also a case where millions have actually left the workforce, not because they simply could not get after multiple years of trying, especially women. Now, while jobless growth is a charge that is thrown at many governments, this government before it, how bad do you think the unemployment situation is right now, and what more can be done from the government side and the private sector side?
So I think the situation has been very tough for many, like you said, migrant workers, for the women in the workforce, etc. But I think few things are happening. One is, if you look at the data, it shows actually that the employment in agriculture has gone up. And I read an analysis that said that this is not default employment. It's not that I don't have a job, so I'm going and joining my family in farming. So there is actual employment which has gone up in agriculture because agriculture has had strong growth. I think the pandemic has also allowed corporates to be very flexible about the workplace. And today technology allows you a lot of flexibility, and which is a good way for us to include sections of society who get excluded very easily otherwise. So I think that's an opportunity, and I think many corporates have continued with the flexible policies that they used during the pandemic, even after the pandemic. Right? So I think that's a possibility. The third area for us to work on is skilling. I think while we are obviously and rightly so obsessed with education, I think there needs to be a greater obsession with skilling in multiple ways. One is
sector-specific skilling.
Yeah, sector-specific skilling work needs to be done by the government, etc. But more importantly, also private sector needs to do more. We should be willing to pay more for skilled people, like we are willing to pay more for a good engineer. I think we need to work through our contractors, etc., to drive that ecosystem. We also need to do a lot of work in society to have greater respect for skills. And I think that's an important part of the solution to the jobs problem.
क्या हाल? मत पूछ यार, फिर से स्टॉक्स में फंस गया। तो स्टॉक्स के साथ बॉन्ड्स, इंश्योरेंस, गोल्ड में बैलेंस कर। इसमें बहुत तामझाम है। तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा है ऑल इन वन अकाउंट। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है। Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Meanwhile, contact-sensitive sectors like cinemas and the hotel and airline industries have been seeing an impressive turnaround for a while as the economy emerges from COVID-19-induced lockdowns. But the recent uptick in cases across the country is worrying this industry again. We bring you a report on the outlook for these businesses.
India on Thursday reported 3,303 fresh COVID-19 cases, the most in over a month, as infections continue to increase across countries led by the spread of the new Omicron XE subvariant. With the uptick in cases, risks of a possible fourth wave and subsequent lockdowns continue to linger. But market analysts believe the outlook for relevant sectors remains strong as the current situation is not alarming.
So there seems to be some anxiety with some recent spot in the COVID cases in the country-wide, although not really alarming, because even today at a country level we just have about 2,000 odd cases on a daily basis, from the peak of almost 2.5 lakh to 3 lakhs. And I think for a country of our size, which is almost 1.4 billion population, I think 2,000 cases is nothing to be worried about, at least at this point in time. In fact, we have invested in a lot of businesses which are part of this open up of the economy. So, for example, investments in the restaurant business, investments in hotel business, investments in media and entertainment, outdoor multiplexes business. So, like for example, we've been talking to a company which is into a soft beverages business, and they seem to be running at full capacity utilization. In fact, they're virtually chock-a-block as far as the utilizations are concerned at this point in time. When we talk to with our portfolio company, which is into a vacation hotel business, their occupancy levels are also running for all-time high, almost 85-90% plus. We've also invested into a multiplayer business, and as you all know, the kind of the box office collection that we've seen, movie after movie, right? That's also very, very strong. We've also invested into a restaurant business, which is a leading QSR, and they also seem to be doing quite well. In fact, I believe the last quarter was very good, Q4 of FY22, and I believe the April month is also doing well. So we believe that the consumer sentiment is very strong. They continue to be confident of going out, and the situation seems to be under control at this point in time.
From the pack, stocks of hotel companies such as Lemon Tree, restaurant brands Asia, Mahindra Holidays and Taj GKV have gained 4 to 14% so far this month as occupancy levels are healthy with wider vaccination coverage and ease in restrictions. Rating agency CRISIL expects a sustained recovery to result in a gradual improvement in the hospitality sector's financial leverage over the medium term. Strong pent-up demand for leisure travel, opening up of international and corporate travel, and wide vaccination coverage should catapult the revenue of the Indian hotel industry by 45% from a decadal low last fiscal and almost match the pre-pandemic levels. The agency further expects a rebound in revenue and leaner cost structures to drive up operating profitability of the sector by 200 to 400 BPS points this financial year versus financial year 2020. Apart from hotels, analysts are also upbeat on quick service restaurants that have seen robust sales recovery in the last few months. Recent channel checks by brokerage Motilal Oswal indicated strong sales growth momentum for quick service restaurants across all brands, similar to trends in February and March. Reversal of restrictions continue to boost mobility, contributing to the healthy recovery in dine-in for both high street as well as mall outlets. Dine-in players are doing better as expected, while delivery has not only sustained at much higher levels than pre-COVID, but has also received a sequential fillip in April. That said, a trend of revenge traveling is also being seen across the board, which has improved prospects for airline companies as well. As per the Directorate General of Civil Aviation, around 1.06 crore domestic passengers travelled by air in March, nearly 38% up from February. The passenger load factor, which means occupancy rates, was also above 80% for all domestic private carriers during the month.
So in the aviation sector, by default, Interglobe Aviation is the largest service provider, has the largest market share, very strong fleet of aircrafts, realization per seat is going up, occupancy is quite decent. So we remain positive. The only issue is short to medium term, the cost of aviation turbine fuel. But as we have seen in the last 3 to 4 months, most of the fares locally and globally have gone up, keeping in mind the higher KTF prices. So I think that pass on has been done. So we remain positive, and the binge or revenge traveling that has been undertaken is extremely visible in terms of the numbers and the occupancy run rate as far as the aircraft flight is concerned. So positive on Interglobe Aviation. And on the multiplexes, PVR, one of the largest exhibitors in terms of Bollywood and Hollywood releases that we see. So over there again, the occupancy is going up.
Therefore, the outlook for contact-intensive sectors remains robust as the economic impact of each COVID wave has been milder than earlier. However, the street will monitor Q4 results of related companies in the days ahead to have a better understanding of the earnings recovery. Meanwhile, on Friday, big corporate names are slated to release their March quarter results, including Maruti, Wipro, IndusInd Bank, SBI Cards, Ultratech Cement, and Tata Chemicals. In addition, investors will closely monitor the US Personal Consumer Expenditures Index and other global cues for market direction.
अब क्या किया?
शेयर्स में ट्रेडिंग।
तुम्हें 5 पैसा नहीं पता?
ओए, अब तो सबको पता है। 5 पैसा पर मिलते हैं रिसर्च टूल्स, पोर्टफोलियो एनालिटिक्स और इन्वेस्टमेंट आइडियाज भी। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
After markets, let's turn to personal finance. It is often said that your scores are a reflection of your abilities and you simply cannot outrun them. While the college scorecard in a way helps you land a job, there is another score that helps you later in life to tide over financial challenges. When you turn to a lender for a loan or a credit card, the lender falls back on your credit score to know more about your credit history. Let us delve into the details of credit score.
The State Bank of India recently announced interest rate on home loans at just 6.65%, but not everyone can avail the loan at such a low rate. For that, his or her credit score has to be excellent. The country's largest lender is providing home loans at attractive interest rates for those with good credit scores. And not just loans, a decent credit score will also help you get credit cards too. So a good credit score helps you avail personal, consumer and other types of loans and credit cards easily. But what exactly is the concept of credit score? Let us find out. There are 4 credit information companies or credit bureaus in India whose credit scores are popular with both lenders and borrowers. These are TransUnion CIBIL, Experian, Equifax and CRIF Higher. A borrower's credit score ranges between 300 and 900. For a bank or lender, your credit score reveals your creditworthiness as a borrower. Scores that are at least 750 or above are deemed to be good. Your credit score is based on your credit history, which encompasses whether you have been making timely repayments, the number of times you've borrowed, the amounts you've borrowed, the types of loan you have availed of, and other relevant factors. Timely repayment of EMIs on loans as well as credit card bills is also an important factor. The score is assigned to you based on your data mentioned in the Credit Information Report or CIR. For example, Experian CIR has detailed information of the concerned person's credit and loan history, including identity information, credit cards, credit accounts, loans, payments, and recent inquiries. Experian updates its CIR every month based on the consumer credit information its member banks and other institutions send it once a month. This data considers the number of times you have applied for credit cards and the number of requests you have made for different loans. Lenders might seek such information, including the credit score, before approving any card or loan. Such requests from lenders are called hard inquiries. Note that a higher number of hard inquiries can lower your credit score because you'll be considered a credit-hungry borrower with a greater risk of default. The percentage of credit limit used on your credit card also affects your credit score. It is advisable to only utilize around 30 to 40% of your credit card spending limit each month to keep your credit score high. Having multiple credit cards or outstanding unsecured loans can also impact your credit score. A healthy credit score will ensure that loans are available to you at more benign terms with lower interest rates, which will save you money. On the other hand, an unhealthy credit score could lead to your loan or credit card application being rejected or being approved on not so favorable terms.
यार आइसक्रीम खाएं? नहीं यार, कुल्फी।
We Indians disagree on everything, but we agree. SBI is the banker to every Indian.
अरे SBI contactless debit card? I agree.
SBI is the banker to every Indian.
The negative effect of hard inquiries stays on your credit score for about 2 years. So when you apply for a new loan or credit card, you may see a small dip in your credit score, but it goes away after a while. That's all for today. For more news and analysis, please log into our website www.business-standard.com. And we'll also be back tomorrow morning with more. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.